Good morning, Carrie. And the treasurer did reach out to me. I'm not sure if he's going to make it at all. He said he was going to try. He said he was trying to log in later. So.
And Commissioner, I did hear from Secretary Romero this morning, and she is unable to attend the meeting today.
Okay.
Would you like me to go ahead and start with roll call?
Yeah. So, what does that mean in terms of a quorum then?
Well, we need 6 for a quorum.
6. Okay. All right. Sounds good. Why don't you get started, Carrie?
Commissioner Garcia-Richard?
Here.
Tim Jennings?
Here.
Carol Lavender?
Here.
Steve Rawson?
Present.
Mike Messina? Nicholas Tejas?
Here.
Catherine Allen? Here. And John Bingaman?
Here.
And let me just go back. Mike Messina, have you joined us? I anticipate he will. But you do have a quorum, Madam Chair.
All right. We would like to welcome our 2 brand new members, Member Allen and Member Bingaman. I'm not sure if you all would like to say a few words at this time, but welcome to the council.
Thank you, and it's an honor to be part of this group, and I am looking forward to the meetings, and I read all 452 pages, or however many it was we sent, but it's a joy to be part of this august group. Thank you.
Yeah, thanks, Madam Chair. I just echo Ms. Allen's comments. Obviously, have a ton of respect and admire everyone on the council and the staff, and I'm really grateful for the chance to work with you all again.
Wonderful. Well, it's great to have you 2 join us. With that, I'm going to go to agenda item 1B. Do I have a motion for approval of our agenda today?
This is Harold. So move. Second, Tim.
All right. We've got a motion from Member Lavender and a second from Member Jennings. Just for the edification of the new members, we are doing all votes with a roll call, even the approval of agenda and minutes, just because we're telephonically, it's a little bit clearer that way. So if I could have Carrie call the, well, is there any discussion on the motion to approve the agenda? All right, can I have Carrie call the roll on a motion to approve today's agenda?
Commissioner Garcia-Richard?
Yes.
Carol Lavender?
Yes.
Steve Rawson?
Yes.
Tim Jennings?
Yes.
Nick Tejas?
Yes.
Catherine Allen?
Yes.
John Bingaman?
Yes.
Let me go back. Mike Messina, have you joined the call?
Yes, and I vote yes, and I want to say how happy I am about our impressive new members. I welcome them heartily.
Madam Chair, that's a unanimous vote, 8-0. Perfect.
Thank you very much, Carrie. With that, we'll move to agenda item 1C, approval of the minutes from our February meeting.
So move, Harold.
Okay, we've got a motion from Member Lavender, a second from?
Lee.
Okay, Member Rawson. Great. Any discussion on a motion to approve February's minutes? We can have Carrie call the roll, please.
Commissioner Garcia-Richard?
Yes.
Carol Lavender?
Yes.
Steve Rawson?
Yes.
Tim Jennings?
Yes.
Mike Messina?
Yes.
Nick Tejas?
Yes.
Catherine Allen?
Yes.
And John Bingaman?
Yes.
Madam Chair, an 8-2, a unanimous decision. 8-0.
Very good. Thank you, Carrie. So, folks, we're going to start on the first part of our informational part of our agenda here, item 2. We'll turn it over to our State Investment Officer. Mr. Moe?
Thank you, Commissioner. Good morning to each of you. And let me echo the welcome comments to both you, Kathy, and John. Let's take a look at the briefing item that is included in your materials. As we always do, we'll start with item A, the current net asset value as of this morning is shown as $32,044,976,000. Distributions over the past 12 months to the state have been $1,055,241,000. And take a look with me, if you will, at the oil and gas related information that is contained in the dashboard. And I'll refer you to the last two boxes on page 2 of the dashboard, which are entitled New Mexico Oil and Gas Production Statistics. Kerry added these back in January. I don't think we've commented on them, but I think this information will be of interest to all of you. Some of it comes from the Craig Group. Some of it comes from elsewhere, Baker Hughes to be specific. West Texas Intermediate is at $61.47 per barrel. The New Mexico Intermediate price as of March 19 was $57.97. Our rig count from March of last year through the 19th of March this year has decreased from 114 to 67 rigs. If you will, please stay with me on the dashboard. And I specifically would direct you to a few items on the dashboard that I think are particularly important. Top left-hand corner, you'll see the impact of our two major funds as it shows distributions to the state in fiscal years 20 and 21. About halfway down the second column on that page, you'll note contributions and distributions to and from the severance tax fund. Those numbers are out of balance, as always, and I think it's important for everyone to reflect on them periodically. On the second page of the dashboard, I would direct your attention specifically to the asset allocation box. I know that's always of interest to people. The performance numbers to the right of that in the middle of the page, particularly the 5 and 10 year numbers, and so much for the dashboard, which we always find educational. Moving now to item C on my report. Member Tellius has volunteered to be considered for appointment to the investment committee, and this will be a matter taken up later on the agenda. We appreciate that. Other committee appointments will be discussed next month. We'll be orienting both Kathy and John, not that either one of them needs to be oriented, but we always offer that. They've each received the orientation materials, and Secretary Romero has asked to also be included in that orientation session with our management group. Depending on how things are looking when we schedule that, it would be nice to be able to do it in person, but if not, we'll do it remotely. We continue to be looking for a financial analyst for Brent's group. I'll give you a quick update on the recovery fund that is managed, as you know, by Sun Mountain Capital. The amount available for loans, $100 million. Funded loans total 24 for an aggregate loan amount of $68,300,000. An additional 3 loans are in the process of being legally analyzed, and those total $5,400,000 for a total of what will likely be 27 loans for $73,700,000. And Sun Mountain tells us to expect about $80 million of the $100 million to be used. Geographically, the loans are in Albuquerque, Santa Fe, Las Cruces, Taos, Rio Rancho, and Farmington. Madam Chair, I believe that covers everything I had, but I would be more than pleased to respond to any questions.
Thank you, Steve. At this time, we'll take questions from council for the State Investment Officer. All right. So with that, we'll go to agenda item 2B, and we'll hear from Mr. Smith, our Chief Investment Officer. Mr. Smith?
Thanks, Madam Chair, and good morning, everyone, and welcome to our new members. We indicated to you over the past couple of months that we would begin our annual springtime macro work this month, and in your packet is our first item, RBK's annual update to their long-term capital market assumptions. These assumptions about future long-term returns from the various markets that we invest in is a significant part of the base that we use to formulate our broad investment strategy and the asset allocations of the fund. So Matthias and RBK will be going through that report for you in enough detail. I hope that you'll get a good feel for what we should be expecting over the longer run, 10 plus year type time frame from returns. Not to let the cat totally out of the bag, but you're going to see some lower numbers than you've seen in the past, and most assumptions that RBK's made here are as low as they've been in many of the years. So we'll go through that for you and start to talk about some of the impacts on the portfolios. Next month we'll be bringing you some asset allocation work and things like that, where you'll get to see specifically what these numbers mean in terms of future expected rates of return from all of our funds. We've got 3 new investments for you to consider. All of them are in the private equity portion of the portfolio. Hellman & Friedman, Capital Partners 10, and 2 funds sponsored by TA Associates. These 2 managers are very familiar to you, and these strategies historically have been some of the best performing investments across the portfolio. So quite anxious to bring those in front of you and discuss those. Dave Lee will lead that along with Mercer. On the macro front, the global economy continues to mend from the awful downturn caused by the pandemic. Europe and Japan are a little slower in their recoveries, but here in the U.S. and in the emerging economies, we're recovering at a faster clip. Here in the U.S. specifically, we're fully recovered and moving ahead on a number of measures from 2019 levels. For instance, housing starts have gone crazy here in the past few months and are up 25% over the peak in 2019. Just the number from February, anyway. Many other measures, such as just kind of broad economic measures like gasoline consumption, jet fuel consumption, capacity utilization, industrial production, numbers like that are anywhere from 2/3 to 3/4 recovered. So we're well on our way to getting back to where we were pre-pandemic, at least here in the U.S. The financial markets, in turn, have been remarkably stable so far this year. Stocks here in the U.S. hit fresh highs just this month. We'll get into that more in the January performance report here in a few minutes. But you'll see some strong numbers when we get to that report. We shouldn't be surprised to see some slowdown here over the next few months. May not, but we shouldn't be surprised if we do see it. We've had a very strong run out of the bottom made in March of 2020, and some headwinds have started to form. The dollar's been a little bit weak here the past few months. Interest rates are on the rise. 10-year Treasury, as we discussed last month, is the most important security in the world, and sets the price of many other things depending on the rate that it yields. And that's up materially from the bottom of about 50 or so basis points. It's up to about 1.6%, so a triple over its lows in terms of yield. So a big move in the 10-year, a very, very important security in terms of markets. And valuations, of course, in most assets, most risk assets, incorporate significant good news in terms of continued economic recovery, in terms of stocks, earnings growth, and also both fiscal and monetary support from continued fiscal and monetary support from the authorities in charge of those things. So moving on, okay, on the macro front, markets have been pretty stable, but I think we should not be surprised if we get a little bit of a slowdown, particularly as we head into the summer with some of the headwinds that are starting to form. So, Madam Chair, I'll pause there for any questions or discussion that you'd like to have, and we could move on into the performance report.
Great, thank you, Vince. Any questions for Vince before we move on to RBK?
Madam Chair and Vince, this is John Bingaman. I did have just one question. Vince, on from a calendar perspective, when would the council look again at the overall asset allocation for the two permanent funds?
Hi, John. Yeah, and hey, and welcome to the council. That was great news. That's going to be in April. We'll start. We'll have land grant, severance, and the early childhood education fund. We're pretty fresh on the rest of the funds in terms of their asset allocations. We'll review them for you and, of course, run them through the new capital market assumptions. But it'll be those three, and we'll do them next month for you.
Okay, thank you.
Anything else for Vince? Okay, I believe we have Marcia and Matthias from RBK on the line. We're going to start with the performance report. Let's go through that, take questions, and then go on to capital market assumptions, if that's okay.
Great, thank you. You do have a January flash, a little outdated, obviously.
Marcia, for the new members, would you just introduce yourself and
I'm so sorry. Welcome. Anxious to meet you face to face, hopefully sooner rather than later. My name is Marcia Beard. I'm a principal and senior consultant at RBK. I've worked on with the council since RBK was hired. I co-lead the relationship with Matthias Bauer, who will be going to the capital markets. And we work for the council, so we are here to assist staff and make sure everything is implemented, but we work for the council, and we are happy to spend as much time as you'd like. If you have any questions, please don't hesitate to call us. And again, we look forward to meeting you. You have a... Shall I proceed?
Sorry, Marcia. Yes, that was great. Thank you. Please proceed.
The January flash is in your report. I believe we would start on page 19, looks at the total fund performance and the performance for the land grant and severance. We'll see some slight underperformance in each of the time periods, but looking at performance for the month, pretty flat for the month, but go over to the fiscal year to date, and the combined total fund was up over 13%, 14%, over 14% for the land grant. So really been strong markets, and as again, the spoiler alert, that is driven further discussion that we'll have today on the capital market assumptions, which are far more modest than because of these strong returns we've experienced. On the following pages, we look at the asset allocation by fund, pretty close to target on most of them. On tax stabilization, the fixed income nexus is at targets combined, but underweight to low duration, a little overweight to the core fixed income. As Vince mentioned, next month we'll be talking asset allocation, focusing on land grant severance, and on page 21, early childhood, which is a newer fund and certainly being implemented to target, but we feel it's, and staff believes it's time to also talk about how that fund should be positioned going forward. Just a couple comments on performance beginning on page 24, looking at the underlying composites. Global equity was up 4.14% for the month, outperforming the global equity index. But what's most remarkable is going over to that fiscal year to date. Again, that's a return from July 1st through January 31st. And you can see that global equity was up over 25% for that period. And looking right below that, you can see that the equity composite of 25% and the non-U.S. composite just slightly below 25%. So strong equity returns. On the core fixed income side, we saw globally yields rose, therefore prices fell, and see that reflected in the numbers here for your core fixed income portfolio, down 0.78, trailing that benchmark for the short term, but long term, nice outperformance relative to the ag benchmark. On the non-core fixed income side, you see some trailing against the short-term benchmark, but notice that the non-core fixed income provided a positive return for the short-term period where, for the month where core fixed income was negative. Also want to just point out that you have two benchmarks now for non-core fixed income. You have the short-term benchmark, and then we have a longer-term benchmark, which is T-bills +4. Going to the next page ever so briefly, and I just want to point out that on the flashes, the performance for private equity and real estate and real return assume a 0% return for any intra-quarter time period. But what I wanted to point out here is for private equity, based on the benchmark study that added the longer-term benchmark for non-core fixed income, you also added the longer-term benchmark for your private equity, which is the all-country world, so a global stock index +3%. And then also looking down, we will be looking at benchmarking for real estate and real return during the period of structure studies that come later this year. Final note is performance. We should be getting performance for February. February was a strong month. So we expect to see returns for February in excess of, for the month, in excess of 1%, moving that fiscal year-to-date return over 14%. So that's a good lead way into saying that capital market assumptions, one of the building blocks, as Matthias will review, is valuations and yield. So looking at how the market is run up, should really be no surprises that our forward-looking return assumptions are far more modest. With that, Matthias and I'll take any questions before we go on to capital markets.
Great, thank you. Questions from council on the January performance report? Thank you. All right, then, Matthias, if you're going to take over on the next agenda item, if you would introduce yourself.
Absolutely. Thank you, Madam Chair. Good morning, everyone. My name is Matthias Sauer, Senior Consultant Principal with RVK, and as much as that, have the pleasure of co-leading our engagement with you all. We do have the first step in this macro series, as Vince mentioned. we tend to start with capital market assumptions. That really lays the groundwork for what we can reasonably expect from the portfolios over the intermediate to long term. So it's always a good exercise to help reconcile where our expectations are with market conditions and get on the same page in terms of where we think the portfolio might fall, potential changes, weighing those trade-offs in terms of taking on more or less risk, and where there are pockets of opportunity. In most of these cases, you're not going to see large-scale changes where allocations are doubled or cut in half, perhaps. But we do see, particularly with funds of this size, we do see opportunities to nudge the portfolio into the direction that is more strategically aligned with the opportunity set in the market or the needs of the funds. And those two are distinct, and we do look at those together. So as I said, the capital market assumptions are very important because they are the foundation for all of the work that we do throughout the year. And we look at them at least once a year. Last year was a little bit unprecedented in our history in terms of actually doing them twice. And the reason for that is we tend to publish them early in the year using year-end data. But given what happened at the onset of the pandemic last year, at the end of the first quarter, we felt the moves were significant enough to warrant a refresh. And I think as Marcia reviewed, the subsequent returns that were experienced in those 9 months we'll talk about just some overarching themes here. And as I mentioned, start of a new calendar year, we're all in the current. A firm-wide effort, and we really leverage all of the expertise within our organization to try and get as much insight and perspective as we possibly can. It's always quantitative in nature, but there is some qualitative, I would say, overlay, just like with anything that we do. The model's only as good as the inputs. It still takes, fortunately, some qualitative assessment and adjustments based on that. Our assumptions, as I mentioned, are long-term in nature, so they're strategic. They're not tactical. We have no idea what's going to happen in the next 3, 6, 12, or even number of years. But history has shown time and time again that over a longer time period, you have a pretty reasonable chance of getting most of the assumptions relatively close. And as a long-term investor with a perpetual time horizon, we think that alignment makes a lot of sense. As part of this process, we look at a lot of things, but the 3 components that are arguably most important and also feed directly into a lot of the models that you'll see in subsequent months and help evaluate various trade-offs, of course, are forward-looking returns, so not historical, but forward-looking returns. We'll talk about how those are informed. The risk or the volatility around those return assumptions. Of course, volatility is not the only risk. There's lots of other risks that we've discussed historically. We try to look at those as well, but it's probably the one that's most uniform across asset classes and one that can be measured relatively consistently. So it's one that is utilized heavily here, but not the only one that is considered and looked at. And then the correlation, so the interrelationship between the various asset classes. The reason why that's important is because if you have offsetting or diversifying assets, you tend to reduce the overall portfolio volatility. So the sum of the parts is better than the individual pieces themselves. We tend to be fairly conservative in those assumptions, so we always base it on the index when we can. So we really just try to capture the beta exposure. What can you expect out of those areas in the market? We're not making big assumptions about a very strong ability to capture alpha or to do substantially better than the market. If that's the case, then that's great. That's That's an added benefit, but it's not our base case. We try to be conservative in that way. And then, as I mentioned, the updates that we make, they factor in a lot of information, but they tend to be gradual. So more of a freight liner, not necessarily a speedboat. And when you have a large portfolio, that's not necessarily a bad thing. Please stop me along the way if there's any questions, comments, or if you'd like me to speed it up or slow down. Happy to accommodate whatever your preferences are. On page 47, just looking at what it means to actually get the capital market assumptions right. That's something that we think a lot about, and I know lots of folks think about what does that mean and how right are they. When we think about getting it right, first and foremost, it's are we capturing the relative accuracy, the relative relationship of the asset classes? So in other words, if we were to ordinal rank them or say, okay, which is going to be the best performer all the way down to the worst performer, are we getting that general order of asset classes right? So if we say equities are above fixed income, they're going to do better. Hopefully equities will perform better than fixed income and vice versa in different scenarios. That's a very simplified way to look at it, but hopefully helpful. And the reason why that's important is that if we get that relationship right, the portfolio should perform quite well, irrespective of what the market throws our way. We obviously have no control over if it's going to be a strong market environment, a weak market environment, things of that nature, but we can try to create an asset allocation that will do reasonably well across a multitude of market environments that are anticipated and expected over that longer time period. And rather than sort of saying, okay, we're going to throw a Hail Mary and hope that this one case works out and work out really well or very poorly. Because again, you have to live through those years that come before and that follow. That's not to say that we don't want to get the absolute accuracy. So, for example, by that we mean if we say equities are going to return 6%, we hope that they're relatively close to 6%, not 12% or 3%, but relatively close to that. The reason that number matters, first and foremost, is because it helps take a look at the reasonableness of various components of the fund, and that is whether the return target is appropriate and sustainable, and we talk about that. We look at intergenerational equity, and that's a big consideration, of course, as well. Spending and distribution. So essentially, are we overspending or underspending based on those expectations? So there's implications there as well. But it tends to follow what the market throws our way. So we care about both. We think about both. But I would say that if we had to pick one that we got right, it would be the relative for the reasons that I mentioned. On page 48, and Vince alluded to this, I think, in his comments, expected returns are low going forward by really most measures. When we look at it against the historical range of returns, and that's the top half of page 48, you can see that they're at the lower end of the historical range, not at the very end, but certainly towards the lower end. These are actual historical returns relative to the forward expectations. And that's a byproduct of what happened, particularly most recently in terms of most of the various market segments. We've seen very strong returns, double digits for equity, even for fixed income, very high by most standards. And so what that means is that we've taken some return from the future. We've essentially fast forward that return from the future into today, and as a result, should likely expect lower returns going forward as that normalizes and mean reverse. We'll talk about that in a little bit. On the bottom half of that page, we show our expected returns, the same thing, but relative to what we've been expecting. And same story that as those valuations, the price that you're paying for that income, for that yield, for those earnings, continues to increase or is at near record highs, our forward expectations have moderated, or at this point are about as low as they have been for the last 15 years or so. So it's not to say that we're not going to get a return. It's just that we think the base case is going to be lower than higher compared to what we've seen. And now, particularly looking back to the onset of the GFC, the last 10 plus years now, it's been very strong. And there's lots of other asset classes that have returned double-digit returns, and that likely isn't terribly sustainable, particularly given how we got to where we are in terms of all the stimulus that has propelled all the growth that we've seen in the capital market. On page 49, this is another page that could be helpful, particularly for those that like to see it visually. We show our assumptions relative to the volatility or the uncertainty around those assumptions. One standard deviation, that's the band or the range that we're showing here, and that tends to capture 2/3 of the potential outcomes, which is a good simple way to think about it. A couple takeaways here as I look at this. The higher the expected return, the wider the distribution of outcomes, probably not surprising. So as we try to reach for more return, we have to take more risk into consideration. And that's risk on the upside, but also on the downside. So emerging markets, for example, private equity are two that you can see the dot. Our expectation is towards the top or at the top of the heap. But as a result of that, the range or the size of the bar is also the widest. And conversely, fixed income, which is offering you very little by way of return, particularly now with yields as low as they are. We've seen some movement this year, but still very low on a historical basis. You can see that the distribution, so the range is quite tight, quite narrow, but you're not getting much return out of that. So these are the kinds of trade-offs that we think about, that we weigh and discuss, and hopefully are useful through the modeling and the asset allocation work to help say which combination of asset classes and what weightings get us to get us as close as possible or optimize the probability of achieving our various investment objectives and goals. Page 50, and again, please jump in with questions or comments along the way. Page 50 is just a couple high-level themes for this year, and a lot of them tend to or have been relatively consistent in terms of what's been driving the market, although direction has changed. Last year, particularly after the end of the first quarter, things looked quite good because of the big sell-off, and so a lot of the assumptions improved and looked quite attractive. Now with all the double-digit returns, or the very strong returns at least, that we've seen across essentially all asset classes, we've had to moderate those expectations, and you'll notice that most return expectations have decreased primarily because valuations have further deteriorated and gotten more expensive in that process. Inflation is a cornerstone or building block in most all of the assumptions, so we do look at that. But most of the inflation that we've seen has occurred in asset prices, not necessarily in the traditional CPI or other measures. And when you're looking at break-even rates or even long-run Fed targets, which have now expressed more flexibility around that, it's still around 2%. So our current assumption is 2%, and we are seeing some push-pull factors here that, particularly as the economy continues to open up or fully opens up, that there could be some inflationary pressures, but those are offset by deflationary pressures that can include continued technological advancements, globalization, which remains strong. So there's no definitive, I would say, reason to move that assumption up at this point, although I wouldn't be surprised if we nudge that up over the coming years. The second component, mean reversion. This is, I would say, something that is a key contributor to nearly all of these assumptions where we compare where we are today relative to history and what that might inform and the tendency for various metrics to come back to their long-run mean. When we're looking at particularly valuations, we see that things are quite richly or fully valued. And then on the fixed income side, of course, yields being at historical lows and spreads have now come back in as well throughout the year. So all of that to imply, particularly out of traditional assets, we may be facing materially lower returns going forward. Pages 51, 52, and 53 provide an overview of how we develop the various assumptions. For most all of them, we try to use some form of a building block methodology, and that's essentially where we think about what are the various sources of return, can they be disaggregated and then individually assessed and then put back together. And so you see that here, we look at yield or income, some component of that, inflation, real growth, which is a combination of GDP and profit margin growth, and then changes in valuation. And the valuation change is probably the most volatile. Over time, it tends to move the quickest. And it can be accretive or it can detract from results. And you see that on page 52, visually across U.S. equities on the left-hand side, non-U.S. equity on the right-hand side. And you can see that the top three, yield, inflation, and earnings growth or real growth, are all contributing to return expectations. Valuations, given where it is relative to historical norms, is actually detracting from forward return expectations as that is expected to normalize. More so in the U.S. than international, or outside of the U.S. And I think you'll see that reflected in our return expectations. Now, this is just, again, this is the raw data. This doesn't mean that these are our assumptions necessarily. We try to reconcile against these, but we don't just look at this and that's the assumption. Page 53, this is a second version of how we approach asset classes, particularly the ones that are more in the private markets where there may not be a great index to measure against, or where there is a illiquidity component that needs compensation as part of the return expectation. And there we have a similar approach, but there's a premium applied to that where we say, okay, what premium should be applied, whether it's based on historical observations, based on the illiquidity or other supplemental risks that may need factoring in and compensating as part of that, and that is added to that build-up process. Private equity is maybe a decent example here, where we base it on U.S. equity, U.S. large cap equity, and then apply a premium over that, where we say what has historically been the premium for that additional liquidity and complexity of the asset class. On page 54, look at the capital markets line and see that, again, that risk-return trade-off, needing to assume more risk in order to have prospectively higher returns. You'll see both a dotted yellow and blue line. The dotted yellow line was at the end of the first quarter last year. The blue line is now. And you can see that line's moved down. It's become flatter, and flatter just means that you're getting less return for each unit of risk. So it's an environment where forward expectations have deteriorated, and perhaps additional risk-taking is not rewarded as much as it would have been 9 months ago. So that could be a helpful observation. We've also added in blue font here a 70-30 portfolio, so that's your equity and fixed income 70-30 allocation, and have that over a number of time periods. And there you can just see as a collection of a relatively balanced or diversified allocation in its simplest form, 70-30, what that change has been over the years, and it's continued to come down. It's done well for the last 10 plus years, but those expectations have continued to come down. On page 55, this is the summary of what our 2021 capital market assumptions actually are and how they've changed relative to the first quarter of last year. Probably no surprise that the compound returns the compound returns is probably the best measure to look at. It's that first column because it's a risk-adjusted return. It essentially combines the nominal return on an arithmetic basis or average basis and incorporates the risk component. So the higher the volatility risk, the more erosion of forward return you have as a result of that. And so there's a bigger difference between arithmetic and geometric. So geometric is a simple way to factor in both components, not just return, but the types of risk that have to be assumed to get those returns, and I think that's a useful measure. So those numbers have come down about 1%, for the most part, and again, mostly driven by changes in valuation. You'll see that non-core fixed income has actually increased. That's primarily due to a change in methodology. As the market has continued to evolve, we are taking a finer approach to that particular asset class, and is consistent with some of the benchmarking work that has done over the last 6 months or so and approved earlier this year. So we have some consistency there in terms of how that assumption is being developed. So we think it's actually more accurate going forward. On page 56, this is just a quick snapshot in terms of looking at the efficiency of the asset classes and prospective expectations relative to historical. I would take this with a grain of salt, but generally would make some observations, probably not too far outside of expectations, that those numbers that are green in the very far right-hand column tend to have better potential prospects going forward than the historical experience. So international and emerging markets, as well as MLPs, probably, which haven't been as good as some of the alternatives over the last 10 plus years, likely will have, or at least be better positioned on a relative basis going forward. So just a singular view, but again, like I said, we look at a lot of different things and essentially build a mosaic around that. Page 57, this is that ordinal rank that I was talking about in terms of compound returns, and we've overlaid your 7% long-term return target for the land grant, and you can see that there are very few, in fact, really just one or two, at least on the compound basis, asset classes that are anticipated of getting you there. The good news is that as I mentioned, by combining different asset classes, you can actually reduce the overall portfolio volatility and get a little bit closer to that. But overall, assumptions have come down, and probably not surprising, you see equities and the alternatives, so the blue and the gray, towards the left-hand side of that chart. And the right-hand side, to the very low end, is primarily filled by fixed income, particularly traditional fixed income. So those are areas that are not going to help materially in terms of getting us to our 7% return target. Not to say that they don't have a purpose in the portfolio, they still do, just not as significant as they have been in the past. When yields are 5, 6, 7%, that's a very different environment for fixed income than when they are positive in a nominal sense, but by the time you consider a 2% inflation expectation, you'll see that there's quite a few of them actually that might have negative real returns over a longer time period. Page 58, just again, sort of saying what if all you did was use the traditional 70-30 portfolio, just had equities and traditional fixed income. What would that mean? Well, it means that you would have done pretty well over time, given what has happened to valuations. You can see that on the right-hand side. The green is your equities measured as the Shiller Cape, and that number has been moving up. So generally, the equity markets have gotten more and more expensive over this time period, and yields, as I mentioned, have continued to come down essentially over this entire time period. And yields and prices move inverse of each other, and so as yields have come down, fixed income has benefited on a total return basis. So this has been a great environment for that type of portfolio. If you think that can continue indefinitely, then that could be a good strategy. But as that spread or as that line continues to open up, I think the prospects are going to get lower and lower over time, and you can see that reflected on the left-hand side. So back in 2009 or so, after the GFC, you saw the return expectations. These are our return expectations, what they were for a 70-30 portfolio for each of those years. We're essentially right at about 7%, maybe just shy of that. And over time, as those respective markets have gotten more and more expensive, as the chart on the right-hand side shows, our expectations have consistently gotten lower as a result of that. And you can see now, even though it was nearly touching that 7% return target, now with 2021, we're somewhere closer to 4%. So it's come down quite a bit over the last decade. And if you want to see, again, the numbers around why, you can see that in the chart below or in that table below, the 10-year Treasury yield, again, just a simplified measure of or one way to look at that. In 2010 was 3.3. At the end of 2020, it was 0.9. So big difference there. And same thing on the Shiller Cape, now over 30. So that has changed quite a bit. And 30 is really back to 2008 levels, and there's really only two other times that it was above 30, and that was the late 20s and then the early 2000s. So it's certainly not to say that we expect that to correct immediately, and there's some argument around, well, if we have low or lower interest rates, maybe that should support higher valuations. There's some argument that can be made for that, although if and when they do move up, obviously that relationship isn't going to hold. So if anything, buys you a little bit of time. On a relative basis, because we said both of these are expensive, or at least expensive by historical standards, fixed income is even more expensive. So equity still looks a lot better on a relative. If you had to pick between these two, Professor Shiller actually came out with a metric, called it excess cape yield, at the end of 2020, that sort of looked at that, and based on that relationship, when you're looking at the relative yield between those, is still in favor of equities, although both, as I said, are not looking nearly as good as they had been. Page 59, just to, again, frame our assumptions. Lots of folks put out assumptions. We don't really pay too much attention to that, other than are we completely missing something? Tends not to be the case. We just kind of stay in our own lane and try not to worry about that too much. Of course, higher capital market assumptions would be easier to digest, perhaps more palatable, but that wouldn't be doing you any service if they were disconnected from what we actually think we can reasonably earn over that long term. And so, hope is not a strategy consistent with that. We try to get it as close as possible, and if the news isn't great or the results are, you need to curtail spending, or make other tough decisions, and those are the kinds of decisions that or we'd rather have those conversations than have the fund fall short of expectations. And you've probably seen that with public pension funds across the nation that have continued to bring down their return expectations as well, increased contributions as a result of that, just because their historical 8, 7.5, and even 7% return expectation have in some cases been tested. And so hopefully we can help you work through that and have an honest conversation about what markets actually will likely give us. Okay, this next section, starting on 60, looks at each of those components in more detail. Some of it is I would say, quite number heavy. We'll just try to give you the high-level overviews, and if there's any additional information you'd like, please let us know. We also have a very extensive white paper that is, I think, 70-plus pages that provides a lot of additional information if you have particular interest, and I'd be happy to provide you as well. Starting on page 60, U.S. inflation and cash, but primarily inflation as a building block in many of the asset classes. And as I said, it didn't change that till 2%, given some of the push and pull dynamics that we are seeing. When we think about that, we look at effectively 3 categories: demand, supply, and what's happening in money supply. Overall, there's still some excess capacity in terms of the economy, so we're operating below full capacity. So the demand really is there's still some slack there. On the social supply side, seeing some increases in the inputs, like the raw goods and labor, although wage growth has been lower than inflation generally. And then money supply is the big one. Of course, there has been a big increase in money supply, and you see that on the left-hand side, that blue line, and it has increased nearly exponentially. But the offsetting force here is the green line, and that's the velocity of money. Essentially, how frequent that money is turning over, how many transactions are occurring as a result of that money. The stimulus is maybe a pretty good example of that. I think the intention is for that to be put back out into the economy, but what's actually happening is, and one of the stats that I saw most recently was that 2/3 of folks were using the stimulus proceeds that were being received to either service existing debt, which of course doesn't spur economic activity, or were saving it instead of going out and spending it, buying whatever that they might have thought otherwise. So unless you have that velocity of funds turning over and generating economic activity, it really isn't having the intended impact. And as a result, we haven't seen that inflation. That's not to say that we can't see that. Again, when things start to open up, balance sheets and even savings rates are again at near highs. So there's a lot of cash on personal balance sheets, which could lead to some inflation, but at least at present, no major imminent risk to that as we see that. And the implied inflation, the break-even inflation, that table at the bottom, you can see, which is essentially market expectations of that, is also very much in line with a 2% expectation now across the term structure here. So we'll feel comfortable, but we do recognize that there's quite a bit to keep an eye on, and obviously we'll continue to keep an eye on that. And as it changes, we'll keep you informed and incorporate that into our model. Page 61. Now we're starting to look at some of the equities, and we've discussed some of this already. Essentially, lower returns for equities, primarily driven by what valuations are, and given the strong returns that we've seen, dividend yields are lower and particularly lower compared to what we've seen historically. The graphic on the left side is a visual representation, again, the price to earnings or valuation metric for equities relative to the forward return. Pretty strong relationship between those two, and essentially what it means is as you pay a higher price for each bit of earnings, you are going to likely have lower return going forward. And so that's not surprising. As you pay a higher price for something, it's going to likely give you a lower return in subsequent periods. And so given that we are on the right-hand side of the PE scale, we're anticipating lower returns as well. Again, this is one lens, one metric, but tends to have reasonably good predictive powers. On the next page, we look at it for international equity. Similar story, or at least trend in terms of down, although relative to U.S. equity, it looks a little bit better on a yield basis. Here we also look at valuation, of course. Those tend to be a little bit better relative to their historical distribution, also relative to U.S. equities. And here we also factor in more on a qualitative basis. What are we expecting from regional inflation and currency implications, and therefore we're expecting a little bit lower or less tailwind, a little bit more on the emerging regions for that. One thing you might notice on the broad international, the risk number going up a bit there, that's exclusively due to emerging markets actually representing a larger part of the non-U.S. equity market. It's continued to increase. It used to be in the low to mid-20s, and given the more near-term performance, it's actually bumped up to close to 30% of that market share. Page 63, looking at equity, but now the private side of things. As I mentioned, this looks at a build-up or a spread methodology, and historically we've had somewhere between 325 and 275 basis points, so 3.25% and 2.75% over large cap equity. That is largely supported by the graph on the left-hand side, where you can see the annual differential and then the average annual differential over this time period, and that's 2.87. Really what we've seen is a general trend line of a lower spread over time, although it can vary quite a bit from year to year. The last 10 years, of course, has been a tremendous environment for public equities. So the ability to, when absolute returns are already very high for public equities, it's difficult for private equity to add material premiums over that. But we do think that the 275 is still a reasonable premium as that market continues to mature as well. Page 64. Now we're transitioning into fixed income, both the more traditional sectors and then some of the plus or the spread assets. Similar to equities, fixed income, actually the price or the yield that you receive is an even stronger predictor of forward returns, given how the bond math tends to work out. And you can see a correlation of 93, so very, very strong relationship between starting yield and forward returns. Given that yields have come down and are quite low, we're not expecting much from fixed income. You still get some roll down benefit if you've got a steeper yield curve. There's still some potential for return, total return at least in the space, but overall, given yields, given where spreads are, and that durations have extended, we do think that this is a space to think carefully about and really re-underwrite its purpose and role in the portfolio. Same is true on 65. So these are the I would say more exotic parts of the fixed income market, high yield, emerging market debt, bank loans, things like that. Lower quality, lower credit quality, but higher yields. So even though the yields and the returns look good relative to fixed income, they are also quite a bit lower, in some cases even lower, bigger change to the downside compared to the traditional fixed income. Spreads have come in, and these are asset classes or sectors that tend to behave more like equity or have a closer relationship to equity than they do your traditional capital preservation fixed income. On page 66, and some of this will be familiar for those that were part of the benchmarking discussion we had early in the year. This is the the core fixed income structure here listed at the top. And even though it doesn't look exactly like the broad market, it tends to have similar characteristics. So whether that's on a duration, yield, or credit quality basis, relatively similar sector exposure, some differences, but all still fairly reasonable. And as we look at that, we get a reasonably close historical return and risk profile relative to the broad fixed income benchmark. And so our base case is to use our standard assumption unless it can be justified why we would do so. And in this case, we think that they're sufficiently close, and that was again the same approach that we used with the benchmarking exercise earlier this year. So we're using our standard core fixed income assumptions for that. On 67, here you have your non-core fixed income structure and assumption, and this is one where even though it has fixed income in the name, it certainly isn't the same as your traditional fixed income. Again, this has different purposes, more of a diversifier, more of an income generator, rather than your capital preservation bucket. You can see that in that table at the bottom, where the green, the strongest relationship is really with equities and some of the return-seeking assets. So because of that, using a far more nuanced approach, and this year in particular, where we're building it up from the individual underlying components listed at the top of this page. You've got 4 sleeves within that, and we've assessed those individually and built them up like we do for your low return bucket as well, and we'll get to in just a minute. Historically, we did more of a spread component, but as yields have continued to come down, particularly the traditional fixed income, that approach just didn't seem to be supported. And given the benchmarking was again, we felt like this was going to be a more consistent and improved process. Page 68 and 69, we look at real estate. And here are no big changes in terms of year-over-year assumptions for core real estate. Cap rates are still low, certainly by historical standards, but on a relative basis, and real estate often is considered as a fixed income proxy, or at least can be for core real estate. It's quite attractive given the spread over treasuries. Those are the yellow lines. And you can see that it's certainly above the average historical spread and still quite attractive. So it's not that real estate has gotten meaningfully more attractive. It hasn't. It's just that some of the alternatives have gotten less attractive, fixed income, and as a result of that, we think that the real estate likely will continue to do quite well, at least relative to fixed income. On 69, we just take those assumptions that we have for core and non-core real estate and blend them based on Townsend's target weightings between both the core and the non-core space. So that's a fairly standard and consistent approach to how we've handled that in the past. Pages 70 and 71, this is your real return asset classes, and 70 just shows you the very basic or naive way to go about that for through the traditional or liquid markets, tips, commodities, and rates. They do have some relationship with inflation or with real returns, but all have their own, I would say, shortcomings. You have a far more, I would say, thoughtful approach to this, and more diversified approach, and that's listed on 71, where you split it between financial assets and real assets. And again, we value similar to the non-core fixed income approach. Now we look at each of the individual components, have assumptions for that, and then build that up into a single expectation. No structural changes, although I know that Paul and the real return team will be likely coming forward with a structure study later this year that may change. That may change some of those expectations or the structure, and of course we'll update that once the decision has been made and approved. And then finally, on 72, this is the severance tax in-state private equity assumption. Historically, private equity was essentially a single bucket, but and essentially reflective of the national program. As the in-state program has continued to grow in size for severance tax, there were a number of voices that felt quite strongly that those should be broken out, and it likely makes sense as it's grown in size. It's still I would say, a difficult part of the portfolio to try and have a forward expectation around. The experience is limited. The portfolio is still relatively concentrated, and it has a dual mandate, as we've listed here, not just returns, but also stimulating local economy and having some other benefits that are difficult to quantify and measure. But overall, in terms of talking with staff and others that have some insight here, these are the assumptions that we came up with last year and continue to, I think, be supported. You'll notice that the return assumption is 3, pretty big volatility, or I would say distribution around that, just given the uncertainty. As we have more information, as the portfolio becomes more mature, more diversified, these numbers will likely change. But the geometric return assumption is actually negative, just ever so slightly, 0.37. And I it's interesting, and I mentioned this at the CIC, last year's return, I believe, was negative 0.3, so almost spot on. Again, we're expecting over a longer time period, so that's just chance, but perhaps for the time being, not an unreasonable assumption. Although I do expect it to change as we learn more. And then last page here, just to have it again on a single page, page 73. These are our final assumptions that we'll be utilizing as part of the asset allocation modeling that we'll bring to you next month, and the potential implications to the risk return expectations. We've done some of that work already and are likely expecting risk and return metrics more in line with what they were before the big sell-off last year, and more how things looked at the beginning of the year, and returns that are going to be lower as a result of that. They'll also have some implications on the intergenerational equity. We saw a big improvement to that last year, given all the tailwinds that occurred with lower returns. Of course, some of that will be given back. And that analysis in all its detail will also be presented over the course of the next few months. So with that, thank you for the time. As always, I'm happy to take any comments or questions that anyone might have.
Thank you, Matthias. And I'm going to push back a little bit on a statement you made about the New Mexico program and its other benefits. I don't think maybe they're necessarily hard to measure. Maybe just by traditional market metrics, they're a little bit harder to measure. But I think
quantitatively into these risk return and correlation buckets, exactly, harder to measure in that framework.
But just in terms of, job creation, investing in ourselves, those are real benefits. So yeah.
Yeah, no, absolutely. I apologize if I didn't clarify that. That's why I was trying to allude to that there are certainly benefits. Those are just difficult to convert into this framework.
And more recently, haven't we seen a little bit of a shift in terms of allocation from the fixed income over to some of the other asset allocations? Hasn't that been kind of a past 2 years shift? Can you talk a little bit about the impact of that, if you didn't already?
Yeah, absolutely. A number of years ago, Vince started the liquidity study essentially, and we've seen the number of iterations there, and we'll likely continue to see refinements to that, where it's essentially acknowledging the lower forward prospects. This is not a new development. It's just that as yields have continued to come down, that the case for that has gotten stronger and stronger, of course. But the purpose of that exercise was exactly that, saying, okay, if we are able to, let's try to measure how much liquidity, since in a lot of cases it's a good source of capital for rebalancing, for distributions and calls as they come in, essentially the first source of capital during sell-offs, and so as part of that, we try to quantitatively measure how much is needed in that particular allocation to satisfy those needs in the event of a strong sell-off. All of that has generally resulted in lower exposure to fixed income. I would say one of the things we're looking at is whether there's additional opportunity to reduce or right-size that allocation. That's still to be determined. But yes, absolutely, it's something that I think Vince has recognized for quite some time, that we've discussed for a number of years, and that you've already taken some incremental action on. But it's something that consistent with my earlier comments, I think gradual changes tend to be reasonable, and so the sooner we discuss these things, the sooner you're able to start nudging in the right direction, the better and the bigger the benefit. Vince, is there anything I missed or anything you wanted to add to that?
No, I think you covered it well. We did that liquidity study initially. It's been 3 or 4 years now, maybe closer to 4 years now, mainly to try to minimize how much we had in fixed income, just because of the low expected returns in that asset class, and try to move more into, real estate and the real return, and a little bit more to the private equity markets, where, expected returns were higher. We came through this, this latest downturn, last year in March, and it actually worked out a lot like we had modeled. So we modeled a 35% drop in the U.S. stock market, and commensurate drops in, the other stock markets internationally, and try to calculate what our liquidity needs might be. And we actually on the S&P 500 got a 34% drop, so very close to what we had modeled and built the liquidity around. And we had plenty of liquidity through the crisis there. Now markets did recover very, very quickly, far more quickly than we had modeled. We modeled sort of a 18 to 24 month period of markets down and then recovering. Obviously that happened in about 9 months, twice as fast as we had modeled for. If markets had taken longer to recover, we would have needed to use more liquidity than we did, but we still would have had ample, if not excess liquidity, based on what our modeling had told us, 3 or 4 years ago. So we're going to take another swing at it and see if we can't, reduce, exposure to those very low returning assets, so we can try to move money into some higher returning assets. Just given the fact that returns overall are so low. So you might see some reductions to the core fixed income when you see asset allocation work next month.
Thanks for that, Vince. I think that's great context for us, especially moving into looking at the asset allocation again. So with that, I think we are going to go to questions from council for Matthias on the capital market assumptions.
Can I ask a question on this on going through all these RVK stuff?
Member Jennings.
Yeah, I was just curious in the inflation levels there. I don't know. It just didn't seem like that is anywhere. And I don't know. Maybe I'm focused too much on one area, but on inflation, to me, it's extremely high right now, and I'm just saying that I'm just looking at building costs. I mean, a 2x4 has gone from $2 to $8, and metal costs are soaring through the roof, and oil has gone from gasoline has gone to $3 or and I just wouldn't that kick that inflation way up? I mean, I don't know. I'm just looking at trying to build a barn, and the people here building houses, I guess constructions are way up because there's no houses anywhere to buy. And the prices in Albuquerque on houses have probably gone up. On a $200,000 house, probably gone up, 15%, maybe more. It's that way in Houston. It's that way in Phoenix. It just seems like to me that inflation is way higher than what anybody is admitting to. Got any comments?
Yeah, I think what you're seeing, and there's a couple different measures of inflation. There's core and headline. It is somewhat bifurcated. There's definitely parts of the inflation and how it's measured, at least by the consumer price index, that have gotten more expensive. But those have been offset by other areas. So education, for example, is one component, and that's historically grown at a rate that's much higher than overall inflation. That obviously hasn't grown given what's been happening with enrollment and the current construct of how education is done. Transportation is another big one as well. That costs are quite low. Gas prices are still quite low, but you're exactly right. Housing, any types of materials that are related to the stay-at-home order has increased quite a bit. So as people have been, confined to their homes, a lot of folks, instead of spending on travel and transportation and other parts that comprise the consumer price index or components of inflation, have been focused more to that. So housing, in particular, home improvement, because folks are at home and are spending more time at home, and as a result, are more investing in things related to their homes. And that's driven up those prices, if you can even get it. I think, as you mentioned, lumber and some of these other things are in short supply at this point because a lot of folks are doing the same thing. But there's other components to that, whether it's apparel is another component. Folks really aren't spending because they're not needing necessarily all the same type of clothing and other apparel that they would if everyone was going to work perhaps on a regular basis. So you're exactly right. There are some components that have increased. Housing probably is the biggest component, but there and medical care as well. Those are two that continue to I would say rise and have risen. But when you look at food and beverages, there you have different components at the grocery store. Yes, restaurants less so. Apparel, transportation down, education down. So some up, some down. And what that means is on an all-in basis, it's still only about 1.7% current, and those are current numbers. So it's just more differentiated perhaps than what we've seen in the past, where things tend to rise a little bit, rise and fall more evenly. Is that helpful?
I don't know. It just seems to me like everything is going way up very quickly. And I mean, even in the grocery store, prices are a lot higher. To me, I don't think it's lower. But I don't know. Maybe it is in the rest of the world, but down here it's pretty high. And all the government increasing government spending that they're pumping into the economy, it just makes me wonder if we're creating a boom only to have a big bust. And, because we're anytime you fool with the market, you have a good chance of screwing things up. But okay, well that's all. I'm good, but sure seems high. Thank you.
Thank you. Do we have further questions?
Madam Chair, this is John Bingaman.
Member Bingaman.
Just had more of a comment and sort of a suggestion for Vince, mostly but keying off of the presentation, which I thought was really good. And I think it sort of highlights the challenge that we face, right? Which is that we're trying to hit, 7% returns, and we've got a basket of investments that is projected to hit around 4%. And, obviously we got to take some more risk to get some more return, but, the stock market's at all-time highs. And so it is a difficult conundrum. I'd like to, suggest that, could we have a discussion in the context of the asset allocation discussion we're going to have about a meaningful increase to the private equity portion? Because I think that's where you've seen a lot of investors like us go to capture some incremental return and do it over time, so that you're not just, putting a bunch of money into the stock market when it's at an all-time high. And so that was just my suggestion, keying off of these materials.
Sure, and I think you really hit the nail on the head when you indicate, we've got low expected rates of return, but we can't just pile money into the stock market like we used to be able to do, right? When valuations were much lower, if we wanted to take more risk, we could just take a bigger swing in the stock market. But that's not the case today. Again, I agree with your assessment that private equity might be a place to go. That's definitely in the mix. If pull down some more fixed income, that's definitely a target area for us. But we'll run you through all of those things and the options that we think we have. Next month when we do those SAS allocations.
Thank you.
Anything further? All right. We thank our advisors at RBK for that very thorough report. Let's go on to agenda item 3, and I'll turn it over to the Investment Committee. Member Lavender.
Hi, everybody. I'd like to add my welcome to John and Catherine. It's nice to have you guys aboard. Look forward to the input you're going to add for us. I also want to make sure you know that the Investment Committee meetings are on the second Thursday of every month, and we certainly would love to have you attend if you have the time and freedom to do so. At the last Investment Committee meeting, Nick and Stephanie, each of whom has attended almost every Investment Committee meeting, were there, and that was nice to. It's great to have more council members there to have an opportunity to have this information firsthand. Again, I'd like to thank Matthias and for that presentation. I think it is very sobering I think John alluded to it, and Vince has recognized it. It was very sobering because of the nature of the calls on the funds, and the fact that it shows that longer term we could potentially struggle to reach even the 7% that is our target. So I think that we have to continue to work on how we manage these funds and see if we can do it safely, but at the same time increase our returns. So that's a challenge. There are 3 investments today for the council's consideration. Mike and I both recommended approval of these 2 to the council, and I think that with that, turn it over to, I believe, David Lee.
Thank you, Member Lavender. And with that, we'll go to our first investment recommendation, Hellman & Friedman Capital Partners 10. David, I'll turn it over to you. You can introduce Mercer and then anyone we have here from the company.
Great. Thank you, Madam Chair, and good morning to the rest of the council. I am here with Chris Cassidy. We are the private equity staff here. Richard Pugmire and Amy Ridge of Mercer are also here. And from Hellman & Friedman, Eric Regatz, a partner, and Suzanne Kemp, who is a director in the Investment Relations Group. These materials start on page 86. They're in the typical format, a staff memo followed by a Mercer due diligence report, and then finally a presentation from the manager. I'll just provide some brief summary comments and then turn it over to Mercer. Hellman & Friedman employs a large cap buyout strategy. The investment check sizes are between $400 million and $4 billion. The investments will be in North American and European investments, and this is historically about 2/3 North American and 1/3 European, and it's moved a little closer to 75-25 in the last 4 funds. The target size of this fund is $20 billion. For perspective, Fund 9 was 16.5 and Fund 8 was 11.1 billion. Hellman & Friedman has 7 core sectors: software, financial services, retail and consumer, healthcare, internet and media, energy and industrials, and business information services. The organization has about 140 employees and over 70 investment professionals that are scattered across 3 offices in San Francisco, New York, and London. Hellman seeks to partner with outstanding management teams in high-quality business franchises. These are businesses with leading and defensible market positions and strong economic profiles like recurring revenue, strong margins, and strong free cash flow. Hellman concentrates the portfolio on their best ideas, which is why the portfolio varies between 10 and 15 companies. This is a little more unusual in our space, and it does make it imperative to have low loan losses. Their loss ratio has averaged less than 5% over the last 5 fully invested funds 4 to 8. The partners own 100% of the firm, so it's an owner-operated firm, and there is no outside capital invested in Hellman & Friedman. This is also becoming more of a rarity in our industry. Hellman has a significant and above-average GP commitment for Fund 10, and this is consistent with the history of H&F and their commitment to their funds. The overall track record is outstanding across market and economic cycles. The majority of the funds over the last 6 funds, so it excludes the most recent fund, which is a vintage 2019, are mainly first quartile funds in the Burgess Global Buyout universe. And funds 2, 4, 5, and 7 are marked at over a 2.6 net multiple, so very, very good. We do like good performance. We like even better when the performance is realized. So the distributions to paid-in capital also reflects the great performance, and the DPIs for these last 6 funds are also mainly first quartile. Overall, this is a very high-quality firm with an excellent reputation, and they have managed multiple leadership transitions successfully, and their funds are in obviously high demand. Staff and consultants recommend a commitment to Hellman and Friedman 10 of up to $75 million. This would be the second commitment to Hellman. We made a $50 million commitment in Hellman and Friedman 9. And with that, I'd like to turn it over to Amy Ridge of Mercer for further comments.
Great. Thank you, David. And a quick introduction for myself. My name is Amy Ridge. I'm a principal at Mercer. Been working with the New Mexico State Investment Council and team for over 5 years now alongside Richard Pugmire. David provided a holistic overview of the strategy and track record. So I would just reiterate, we are very excited about this investment. The Fund 10 is heavily oversubscribed and hard to access. So we're very pleased, due to your strong relationship and existing investor status, that we were able to secure an additional $25 million increase compared to your last commitment. The things that we really like about Hellman and Friedman, they are a well-established firm. They have a 37-year history. The current leadership team has a 25-year average tenure, and they've spent almost their entire careers at the firm. It's interesting, most of them, actually all of them, have worked their way up from an analyst or associate level. Overall, they have a large investment team that is a long tenure together and very low turnover. The track record, as David mentioned, has been very impressive, with above median returns across the last 7 funds, 5 of which are top quartile. We also like how far back they span, which is to 1995. And lastly, the firm only has 1 fund series, which is a rarity for a firm of this tenure and stature. We like this because it ensures that the entire team is focused on the same portfolio. A few areas of consideration that we spent time on. The fund is expected to have a more concentrated portfolio. However, this has always been their strategy, and they have executed it well with strong performance to date. The other item is they recently executed a few cross-fund sales. These types of transactions can sometimes cause potential conflicts of interest, but we do like how they manage. Like they had LPAC approvals, as well as independent third-party valuations of the transactions. So at this time, I'd like to turn it over to Eric Regetz, a partner at Hellman & Friedman, who has a 19-year tenure with the firm. And he was also actually here in 2018 presenting Fund 9 to you all, as well as Suzanne Kim from their investor relations team.
Terrific. Thank you, Amy. And good morning, everyone. This is Eric Regetz, as Amy mentioned. I think that was a great overview, and we are very appreciative of the comments from both David and from Amy on our fund. We value this relationship quite a bit. We actually really consider ourselves stewards of capital, so it's always a pleasure to be with our investors here. And your participation in Fund 9 has always been greatly appreciated. You know, you guys are obviously sophisticated private equity investors, and I think that those were great overviews. So I will try and keep my remarks here quite brief, and then just open up to questions on anything that you might have around our firm or what we're seeing, or frankly, any matter that you'd like to discuss. I think, as was pointed out, we're a pretty different beast in the world of private equity at this point in time. You know, we've really taken a tack of, frankly, just simplicity and consistency, I would say, are kind of the 2 words that I'd highlight. Simple in that, you know, we have not become a broad-based financial institution like many of our large cap peers today. We have not sold outside or equity outside shareholders. We've really just kept incredibly focused, and that's focused on doing one thing well, which is trying to be the best private equity firm in the world. You've got 140 individuals now in our institution that really wake up every day focused on just trying to make great investments, be great partners to our management teams, and ultimately build better businesses to deliver exceptional investment returns. We do that in a very focused way. It's a pretty simple investment philosophy, but it's one that has defined us now for 37 years, which is just buying great businesses. And it's as simple as businesses that are sustainably differentiated, produce real cash flow, have great management teams, and grow. You know, those that were here in 2018 would have heard me say that before. You know, that's part of the consistency part of that, and it is a little bit of motherhood and apple pie. But what it really means is we're not doing turnarounds. We're not trying to predict the price of oil, or as one of the members suggested, the price of 2x4s near term. We're not buying undifferentiated businesses at low multiples. We're not making venture capital investments. We're just trying to make a few very high quality investments into things that we got very high conviction in their ability to grow and drive future performance. It's one of the benefits of the asset class. We do call capital when we find things, and so it allows us to be very patient in how we approach the market. We're big believers in alignment. So, you know, part of that is the GP investment that was mentioned. We'll have over $1 billion amongst the GP invested in our funds. We eat our own cooking in that regard, if you will. We always invest in the same securities as our management team, so there's alignment there. We don't take any fee income that's any different from what you would be receiving, so our profits are very much aligned. And more than that, we only believe in getting in business with people that share the same values that we share and share the same definition of what success looks like. And that's, again, building great businesses that will endure and grow over the long term. Culturally, we're, you know, really are a small group of people. It was mentioned the long tenure. We're down to earth. We're probably a firm whose brand gets in the Wall Street Journal less than others. That's fine with us. What's fun is really building great businesses and partnering with great people. And so it's really led us to this approach that, as I say, is pretty different from what most of the rest of the private equity firms out there have built, but one that, you know, we think has been critical for our successful track record, which is 30% a year for the last 30 plus years, 2.5 times gross multiple of money produced. We think about both of those things. High IRRs are nice, but ultimately you're in the business of serving liabilities that aren't going to be due mostly next year or the following year. So we believe in compounding capital and finding longer term investment opportunities. And we do that by having a very low loss ratio. We don't think ourselves as running a portfolio. We think of ourselves as having a collection of very high quality investments, each one that must stand on its own 2 feet. And then we built a dedicated firm and investment process around that. The world, as I think was mentioned earlier, is a hard place these days. You know, the valuations are high out there, but I think our approach to finding great businesses, to getting high conviction in companies and increasingly growth, some disruptive stories, is one that we feel very good about as the world goes forward. And given the team and the investment platform that we've built, we feel very good about what the future of Fund 10, and then looking beyond that, 11 and 12, we're in this for the long term, really will bring to Hellman and Friedman, and then ultimately to our LPs, to you as the State Investment Council here. And so we are very pleased to be here, and thank you for the consideration for Fund 10. With that, I would be happy to open it up to any questions, or David, if there's anything that you'd like me to comment on before going on.
Thank you, Mr. Regatz. And so at this time, we will open it up to questions on this particular recommendation from council members. You can ask either to our staff, Mercer staff, or to the representatives from Hellman and Friedman who are on the line with us.
Oh, this is Lee. I got you.
Yes, Member Rothman.
And I don't know, maybe it's to any of them, but you have an upward limit of investment of up to 20% in one entity. And that seemed like a pretty high
number. Most of the time we're seeing that down around 10, 12, 15. And I just wanted to maybe get some comments on that.
Member Rawson, this is David Lee. Typically what you see in the terms for the fund are constraints that are a little bit more loose. It gives the manager a little bit more flexibility. I don't think that they really intend to do that. It's not like an investment plan. It's not what they target, but most managers do like to put flexible terms in their LPA, but I don't think they intend to do that up to 20%. But I can turn it over to Eric for further comments on that.
Thank you.
Yeah, I would reiterate that what David said. That really is the intention here. I think our sweet spot really is kind of in that. Historically, I would have said $1 billion equity check into any investment. I think probably now 1 to 2 and 3 would be a very big position for us. We're generally looking for 10 to 15 investments per fund here, and so that would put you in a range that's certainly a lot farther south than that 20% number.
Well, I guess if we look at your previous funds, what's the largest percentage that you put into any one entity? Just roughly guessing. I mean, I know you won't have it offhand.
Yeah, Suzanne, you may have that data right in front of you. I think it would have said $2 billion. Yeah.
About $2 billion.
Would you repeat that? I don't know if we heard it.
I think that would be about 15%.
About 15%? Okay, thank you. And while I have Eric, Eric, you mentioned that you eat your own cooking, so I wondered if you wanted to tell us how much you weigh.
I'm happy to send you a picture if it helps with the investment decision. Well, I'm putting all of my as much money as I have and can into the Hellman and Friedman funds. We all do that really in terms of we think it's the best investment decision that we've got as a firm.
Yeah, on a more serious note, though, there's some discussion in here that you like to have a concentration on best ideas, but there's really no definition of best ideas. It's like, whose best idea or what qualifies as the best idea? I just thought maybe you could have a little more discussion on that.
Yeah. No, it's a great question. And I would say really there's two elements of that, and then maybe I'll overlay that with the investment process so you get a sense of that. You know, it's really for us, one is about, we talk a lot about fit and fit with our investment philosophy, and that's really a non-quantitative thing. It's really about, you know, what is the nature of the competitive position? How good of a business do we think it is? How good is the management team? How much conviction do we have in the growth prospects? You know, is it something that we can say, this really fits what we're trying to go do? Second, then comes to, obviously, we have to price these investments and turn that into a quantitative judgment. And in so doing, you know, we can find things that we think produce investment returns that are full and fair, or prices that are full and fair, and you know that gets us to our investment targets. Or we can find things that, for whatever reason, we think have a lot more upside. So it's really that combination of fit, which is a little bit about downside protection and a little bit about just conviction in our ability to underwrite and grow the businesses. And then the price that we have to pay kind of comes together. And, over the course of the year, we'll see hundreds of investments, probably more like tens, 20 to 30 that we actually really look deeply at over the year, because there's so many things we just filter out because they don't fit with us. Maybe somebody else can make money on them, but, they don't fit with our area of expertise. And so it really comes down to ultimately that judgment around the business, which is then a judgment both of the investment teams that are working on that. I personally lead our efforts in the consumer and retail arenas and some of the business services things. And then we have a 4-member investment committee that ultimately is the allocator of capital, the ultimate decision making, to make sure that we've got consistency that is applied across industries. And brings the best thinking in the firm there.
Okay, now, also there seems to be some limitations as to no more than 7.5% into oil and gas. I thought you could comment on that, and then also no real property. And I thought maybe you could comment on that as well.
Sure. And Suzanne certainly chime in here too as I'm going through it. Those are generally our limited partners have asked us to put those limitations in, given how many firms and investment organizations think about those as just different investment baskets. And so, people will have oil and gas strategies or real estate strategies. And so they've said, let's keep you in the bucket of doing private equity investing outside of those arenas. I would also add, I'm not an oil and gas expert, so there's really no danger about getting into those areas. As I say, we're really trying to focus our investments in things that we've got distinctive competency in. But those were really, I think, as much limited partner-driven provisions as anything coming up from us.
Okay, what about the real property?
Yeah, real property, and again, Suzanne, really that's about real estate. And so people having different real estate strategies and investment managers where they want to focus that risk-taking versus blending that in with the broader private equity pool. But Suzanne, I don't know if you want to comment on anything.
I would absolutely agree, and I think there are also some tax consequences of real property investing as well, which is why some people comment on this in the legal documents.
Well, I'm assuming that in most cases, the companies you buy probably own their own facilities or not. Will you try to keep that outside that environment? I mean, I understand that you're not going to be a REIT to do those types of things, but as you acquire, I'm assuming that in many cases that's the acquisition of that real property as well.
Yeah, I would say, that is often the case, and we're not precluded from buying companies that actually own assets and own real property as part of their non-real estate businesses. But I would say actually increasingly, I'd say most of our firms really probably don't own real property. I think the cap rates on things have been such that there are more efficient holders of a lot of that property. And, there are certain times where you really want to own real property because it is a core part of, your franchise, your business model. But in general, I think the things that we're investing in are not so much, theme parks or something along those lines where if you didn't actually have control of your property, you'd have a real threat to your business.
Okay, and maybe for David and Mercer, maybe you could comment a little bit on the fee structure. It just seemed a little unusual.
This is David. Thank you, Member Rawson. The fee structure and incentive compensation for this fund is a little bit different than a lot of our funds, but it's not very different from our most competitive funds. As we went through the discussion about Hellman, I think some things about how competitive it is to get into their funds, how well historically they've done over a long period of time, and how oversubscribed they become. As a result, there is a lot of competition to get in, and therefore, what you'll hear is some of our managers have terms that are a little bit different, but we do end up looking when we underwrite it, and Mercer underwrites it. We look at the overall net return. So we do try to take everything into account when we make a recommendation, and that's why we feel strongly about Hellman and Friedman 10.
All right, and Eric, I'm just looking at your picture and Susanna's, and I am concerned about your cooking. But how would you pronounce Philip's last name? It doesn't matter, but it's kind of the last question.
Yeah,
how do you say
Hammarskjöld. Hammarskjöld. It's Swedish.
Swedish. All right. Thank you for your help or your answers.
Thank you, Member Ross. Further questions for our panel here?
Madam Chair, this is Nick Taves.
Yes, Member Taves.
Hi. I just wanted to point out some of the conversation in the CIC meeting that we had. And if you take a look at page 160, I believe, it's It's tab 3B3, Hellman and Friedman Capital Partners, and the Fund 10 manager presentation. It kind of article returns for this investment, and we were very impressed by this. We were looking at 22% IRR and gross multiples of, through history of right around over 2 to 3 times the invested capital. So, I just wanted to say that I really support this investment, and I think it's a really wise investment decision for the council and the state. And if you want to just look at that page on 160, it kind of spells out a lot of the value of this investment. Thanks.
Thank you, Member Tejas. That sure helps to reinforce what a robust recommendation this is. Any further questions? With that, I'm going to go to Member Lavender for a motion.
Thank you. This is based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff in general, fiduciary oversight of RVK. I move that the State Investment Council approve commitment of up to $75 million to Hellman and Friedman Capital Partners, 10 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender. Second. Okay, we've got a second by Member Allen. Awesome. Any discussion on that motion? All right, if we could have Carrie call the roll on a motion to approve the investment of up to $75 million to Hellman and Friedman.
Commissioner Garcia Richard?
Yes.
Harold Lavender?
Yes.
Lee Rawson?
Yes.
Tim Jennings?
Yes.
Mike Messina?
Yes.
Nick Tejas?
Yes.
Kathy Allen?
Yes.
John Bingaman?
Yes.
Again, Madam Chair, unanimous decision 8-4.
Very good, and we thank the representatives from Hellman and Friedman for joining us today. With that, we're going to move to our next sort of set of investment recommendations. So, David, the way I like to do this, I don't know if we've got folks from TA on the line, but could you run through the terms and recommendations for both of these investments, and then we'll take questions. Obviously, we'll vote on them separately, but
Sure.
I think the presentation can be done together.
Okay. Yeah, that's fine. Thank you, Madam Chair. I wanted to introduce Richard and Amy from Mercer are on, and Chris is on from our staff. I did want to introduce Ajit Nedugadi. He is the CEO of TA, and Andrew Harris, who is the Director of Investment Relations. They are joining us from TA Associates. Just a quick summary on both TA 14 and TA Select Ops 2. TA is a global growth and buyout strategy focused on the middle market. The investment check sizes will average 200 to 250 million for TA 14. Geographically, TA investments will be mainly in US and Canada with a 60 to 70% target. Europe has a 25 to 35% target, and there will also be some exposure in Asia, as evidenced by a 5 to 15% target. Fund 14 will have 50 to 60 companies. The target sectors are technology, and this is mainly software and fintech, financial services and business services, healthcare, and consumer. Fund 14's target is $10.5 billion. Fund 13 was 8.5, and Fund 12 was 5.3. There is a large and above average general partner commitment here, and TA will once again be the largest investor in Fund 14. The organization itself is one of the oldest private equity firms. It became an independent partnership in 1977. The firm has 187 employees, including almost 120 investment professionals. They are located in 5 offices globally in Boston, Menlo Park, London, Mumbai, and Hong Kong. TA, also wanted to mention, is also well known for its extensive sourcing and origination capabilities. A recent focus of the TA strategy is on high-quality business models, which they define as high proportion of recurring revenue, quality earnings growth and cash flow, low customer concentration, strong margins, and low cyclicality. And in addition, the portfolio companies benefit from the Strategic Resource Group, that is their consulting arm, which has grown to 12 employees and is expected to grow to 20 plus in the next 5 years, and its 4-employee capital markets group. Performance, as you would expect, is also very strong here. 3 of the last 4 funds, excluding the most recent fund, TA13, are at least a 22% net IRR and a 2.0 net multiple. They are mainly first quartile in the Burgess Global Buyout and Expansion Capital Universe. The TA equity funds have gained almost 24% in the last 10 years as of 9/30/2020. That's compared to the almost 14% for the S&P and 18% for NASDAQ. TA also continues to do a great job returning capital. 3 of the last 4 funds, not including the most recent one, rank in the first quartile for distributions to paid in capital, or DPI. And they have a target of 30 to 40% of capital return through full and partial exits in any given year that they shoot for. And that's one of the main reasons for their success on the DPI scales. This is, again, a very, very high-quality firm. The funds are obviously in high demand. Staff and consultants are recommending a $100 million commitment to TA14. Currently, the State Investment Council has 3 commitments to TA, a $100 million commitment to TA12, which has over a 35% net IRR and a 2.0 net multiple with a vintage year of 2016, a $100 million commitment to TA13, which is a vintage year of 2019, and a $58 million commitment to TA Select Opportunities, which is a 2020 vintage. And before that, we had previously committed $21.25 million to 3 TA funds from 1997 to 2000. When you add all that up, the TA funds have generated a net IRR of 23% and a net multiple of 1.7 times for the national program, again, as of 9/30. Per the chair's recommendations, just to highlight some things, TA Select Opportunities 2 differs from TA14. TA14 is part of the main fund series. You've got more companies, 50 to 60 companies, and the check sizes are bigger because the fund is bigger. The TA Select Opportunities series is more of a continuation fund. It's the same strategies, but it has specific hurdles. This is a best ideas fund series, and the way that they define that is they're going to invest in certain high-performing current TA portfolio companies. In other words, companies that are in TA 11, 12, 13, and 14 that meet a minimum hurdle. In other words, they've already achieved a 2.5 times return. And TA would invest alongside an independent third-party financial sponsor who would be the lead investor in the transaction, and Select Ops would take a minority round, and therefore the lead investor would set the price. So if that's a little confusing, let me just put it this way. There are successful companies in the main TA portfolios, and if they reach at least a 2.5 times hurdle, and TA, the main funds, decide that they want either full or partial liquidity, then they will solicit third-party investors. A lot of times they've worked with the same people to basically make a bid to partner in the continuation of the company because they still believe in the company's prospects. That company will then negotiate terms, and then it will go to TA Select Opportunities, basically investment committee, so that they decide whether they also want to be part of continuing it. And just to be clear, a lot of companies that reach this hurdle that are in the TA funds don't meet it, don't meet all the criteria and get to go into this fund. That is because this fund series, unlike the main fund series, is very concentrated. It's 12 to 15 minority equity investments. The check sizes are obviously a lot smaller because the fund is smaller. The check size is 50 to 150 million. The target sectors are the same, but the focus on the high quality business models leads more to an emphasis on software and payment processing. The target size for this fund is $1.5 billion, so considerably smaller than the main fund series. And Select Ops, the first one, was $1 billion, so it's just a little bit bigger than that. As with the TA main funds, this has an above average general partner commitment. And TA, the main reason to set this up is they believe that they benefit from asymmetric knowledge of these companies and their markets on a risk-reward basis, from having originally invested in these companies and seeing the fruits of their success, dealing with the management teams, dealing with the products and the market. They believe that they have a higher level of confidence and therefore a smaller range of outcomes. That being said, the return targets are the same as the flagship funds. They seek top quartile performance. And the fund terms also reflect this approach in the fact that the carry is typically what you would see in a lot of funds, but there is no management fee charged because they've already done the due diligence on these companies. That's a summary of Select Ops 2, and just wanted to finish up with staff and consultant would recommend a commitment of up to $40 million to the TA Select Opportunities Fund 2, and this would be our second commitment to the Select Opportunities Fund Series with $58 million to Select Ops. Hopefully that wasn't too confusing as I tried to sum up both of them at the same time. And with that, I can turn it over to Richard Pugmire of Mercer for further comments.
Thanks, David. This is Richard Pugmire. I'm a partner on the private equity team at Mercer. Just by way of background, I've worked with the SIC since 2011 when the National Private Equity Program restarted, and started working on the New Mexico Private Equity Investment Program in 2019. I'd also like to welcome the new council members and look forward to working with you. As you can tell from the introduction that David gave, both staff and Mercer continue to believe TA is a strong manager. This is a highly sought after fund, and we believe that both TA funds we're talking about are expected to be significantly oversubscribed. And we're happy that we're maintaining our allocation in these funds, so you don't have to worry about getting cut back. Just to reiterate some of the reasons why we like TA. When you look at TA, they have a large senior leadership team of 24 managing directors who average 17 years at the firm. They've really found a way to be proactive at succession and transitioning senior leaders over a long period of time. I hear from other private equity firms all the time that they reach out to TA to learn about what they do since they are considered the standard. From a terms perspective, David mentioned the large general partner commitment to the fund. Even with TA growing their fund, the commitment stays large. When you dig into what is driving that, the team has also shared in the success of past funds, and the investment professionals are really reinvesting in the next fund, which is exactly what you want to see from a private equity firm. From a strategy perspective, TA has always been strong in sourcing. It continues to be very active and proactively seeking investment. This is another area where TA has really set the market standard, and you see a number of other private equity firms seeking to copy their approach. They also continue to evolve and improve resources over time. Over the 15 years that I've tracked TA, I've seen them add more operating resources and capital market resources which has added value to portfolio companies. And I like that they're constantly seeking ways to improve. TA has had a strong track record, particularly over the recent funds, where only one fund is really underperforming. When you look at what's driving it, they've really had strong realized performance. So it's not just writing up the value of the companies because the market is up. In particular, they had an impressive 2020 for generating value, which I think really speaks to the quality of their companies. When you look at some of the areas of consideration, we are in an environment right now where there's an increased use of leverage and there's acquisitions at higher prices in the industry. TA's funds have also experienced this. But when you dig into TA's process, they really focus on companies with more stable, recurring revenues that can support the debt. TA's focus on high-quality companies sometimes leads to paying higher multiples, but they are able to get that down over time through add-on acquisitions of smaller companies. There are also potential conflicts as TA manages sub-debt funds, which also provide debt to the portfolio companies in the fund. But they have been successfully executing this strategy for 21 years, and they have a prescriptive way to set up the debt and involve the limited partner advisory committees of the two funds if conflicts arise. With the Select Opportunities Fund, David did a good job summarizing what this fund is. It's really the same TA team managing the strategy. And similar to TA14, the TA team has also made a large commitment to this fund. So there's good alignment between the investment team and limited partners. We do like this fund as a way of getting more exposure to TA's portfolio companies in a more cost-efficient manner with the more favorable terms. This fund is expected to be more concentrated with fewer investments and potentially more industry and geography exposure, which is one of the reasons why you see the smaller commitment size compared to TA14. And the nice thing too is TA also re-underwrites all of the investments in this fund. So they make sure that they have high conviction, and to manage any conflicts, they have a third party that actually prices the transaction. So to reiterate what David said, we're recommending a $100 million commitment to TA14 and a $40 million commitment to TA Select Ops 2. With that, I'd like to introduce Ajit Nedugandhi, who became CEO of TA this year, and he's been with the firm for 21 years. And Andrew Harris, who's the Director of Investor Relations, is also on the line. They're going to give a short presentation, and then we're happy to answer any questions the council has.
Great. Thank you, Richard. Thank you, David, and thank you to the Investment Council for having us here. We're very pleased to both present and, more importantly, very appreciative of the long-term support that we've received from New Mexico in our previous funds. I will go through some brief commentary about TA, what we think makes us unique and different, and then open up to questions for the remainder of the period. So I'll focus on a few things, and I'm not particularly going to follow the slides in any real order. I'll talk through TA, and you do have some backup material, I'm sure, in front of you. A few things about it. First, the organization. I'll comment on the nature of the organization, which we spent a lot of time on how we structure it, on our culture, and on our overall approach to building the firm. The second is the strategy. The third is the unique tactics that we deploy to go about executing our strategy. And then the fourth is our very specific and long set and disciplined decision-making process. On the organization itself, I'll focus on a few things. One, we are a large organization. As David went through, we've got offices in all around the world. We've got a large scale of investment staff. We've got 24 investment partners who have been with the firm for 17 years on average. I myself have been at the firm for 21 years. The vast majority of our partners grow up inside the organization. In fact, all of them either start as vice presidents or as associates and grow up inside the organization, and that creates a real continuity of culture. We have a very specific and well understood method of determining ownership, which we think is one of the reasons that leads to this cohesive long-term culture. We have a way of attributing performance on a transaction by transaction basis that is well understood and accepted in the partnership, and that then results in a well understood methodology to determine how much an individual owns in the firm. We are culturally known for being very entrepreneurial. We're known for a distributed organization of entrepreneurs that are out there with a real hustle and style of decisiveness in making investments. We're really strongly in transparency of communication, intellectual honesty, in particular in the way in which we communicate it back to our limited partners. And as was mentioned, we are very much aligned with our limited partners. We own 100% of the GP. We have no plans to not own 100% of the GP, and we are the largest LP in our funds and expect to continue to do so with $1 billion of capital invested in this current fund. So that's the organization. On to the strategy then. I'd say there's three key legs to strategy. First, we're multi-sector experts. We focused exclusively on 5 very specific verticals: technology, which is predominantly software; financial services, which is predominantly asset-light financial services. So it's areas like wealth management, payments, electronic payments processing, financial products distribution, insurance, for example, and not balance sheet heavy financial services assets. We invest in healthcare, and in healthcare, we very specifically in the U.S. focus on businesses that are focused on bending the cost curve and reducing the cost of delivering healthcare in the U.S., and then recently, increasingly in new areas of pharma as it relates to gene and cell therapy, where we've had some successful investments. And then in Europe, we've had a very successful strategy of medical device investing that's been built over the last 10 years. In business services, we tend to focus on intellectual property-based, highly recurring, high-margin business services. And then in consumer, we have refined our strategy after some mistakes that were made in a 2006 fund in particular. We've really refined our strategy to focus on durable, repeating, non-discretionary purchases in the consumer space, and that's a strategy that has gotten some real traction and resulted in a high-quality portfolio. So we've got decades of expertise in each of these areas. The entire organization is designed in these areas, so we have a healthcare group, and all of the investors in the healthcare group spend all of their time in that sector. Similarly for financial services, similarly for business services, and for software, and for healthcare. And for consumer, sorry. And then those organizations are then replicated both in Europe and the U.S. The second leg of the strategy is our focus on quality. And this is an emphasis that we have significantly increased in the last 10 years, starting with TA11. We use this somewhat awkward acronym HQBM, high quality business models, to describe how we feel about a business. And that is a very clearly laid out methodology of thinking about level of recurrence in the revenue model, retention, churn, pricing upside, pricing optimization, length of contract cycles, capital intensity, sustainability of the margins, the competitive moats around businesses, cyclicality, level of business concentration, and regulatory risk. So there's a whole range of different factors that we put into the mix when we think about quality of business model. And if I were to define our strategy, it is to identify the best platforms, the highest quality platforms we can find in our target verticals, be comfortable paying the sort of premium prices that are required to be paid in the current environment, and then work to transform those businesses into much larger businesses and into more efficient businesses through a combination of M&A and then operational value add within those businesses. And so as the market has gotten more competitive, we have continued to go up on the quality spectrum to invest in the best ideas that we can identify, and then to have a very clear plan of working with them to transform them to create much greater value than the business as usual case might allow. So that's on quality. And then the final is that we're investing in growth businesses. Growth is our fundamental return driver, has always been our return driver. We've expanded our view on growth to include both organic growth, which is where we've always been focused, and the majority of the portfolio is a high organic growth portfolio. But we have expanded our thinking, particularly leveraging what was mentioned by Richard and David on the origination side, or leveraging our origination capabilities to help drive M&A drive growth within our platform companies with portfolio add-on acquisitions. So if you look at the growth rate in our portfolio, it will be many multiples of GDP growth, both on not just on the earnings side, but also on the revenue side. So that's the three key legs. It's the multi-sector experts, focus on quality, and focus on sustainable growth. And then I'd say in terms of execution and tactics, there's a couple of things I'll emphasize here. One, and it's been mentioned before, we are very focused on an origination strategy that we had in place for decades that drives a very high volume of outbound activity. We're reaching out to tens of thousands of companies. We're physically, and when we could physically visit companies, and now we're doing it over Zoom, but we're physically visiting 2,500 companies across the world a year in order to identify 20-odd opportunities that we end up making an investment in. So there's a real view that says touching and meeting with and building relationships with a very large number of prospects in very targeted areas that we have a real sense of conviction, and these areas change and evolve over time, a sense of conviction about the strategy and the future prospects for businesses is a good way to invest. The second emphasis I'd make on execution is on liquidity. As was mentioned earlier, we do spend a lot of time thinking about systematically selling, particularly when we're in this sort of a high price market. We have a real view that says we want to be buying and selling in the same environment, and we have a big portfolio, very different. I was just listening to the tail end of the H&F presentation versus H&F. We are much more diversified. We've got 60-odd companies in a fund, and as a result, are very focused on continuous liquidity and can do so with more flexibility, more continuous liquidity, and we're often doing things like partial recapitalizations and partial sales of our assets. And even when we take companies public, we tend to hold on to our shares for a while and then sell them systematically over a long period of time in the public markets. So we've got a real active and strategic approach towards liquidity generation and systematic liquidity on an annual basis. And then the last point I'll make is we have a very well-defined decision-making process that's been in place for decades. Our IC process is a little unique. We don't have a standing Monday morning 4-hour investment committee comprised of 3 or 4 individuals, as some other firms might do. We actually have I chair what we call our core investment committee, but actually what I do is I assign a delegated investment committee per investment, whereby the delegated IC actually has the authority, has the pen on a given investment, strongly advised and with a lot of input from the overall investment committee. But the delegated deal IC then meets with the individual company, spends a lot of time, and this happens 60 times a year across all the opportunities we consider, spends a lot of time with each individual investment, actually puts down their thoughts in writing in a lot of detail. Again, a very unique aspect of the way we approach underwriting, which we then think all of that leads to a much more detailed process of underwriting, a much more thorough process of underwriting, which then we believe is reflected in our long-term returns. And with that, I'd summarize and say 14 is the same strategy. We're looking to, there's no real change. Same industry, same organization, benefiting from the same long-term decision process and with the same target returns. And with that, I'll hand it back to David and Richard or to questions.
Thank you, Mr. Nedagandi. Is that?
Yeah, close enough. Thank you. Nedagandi, yeah.
Nedagandi. Okay, very good.
Sorted out.
Well,
I thought
don't tell me no.
So if we could have members mute, please. Remember to mute your phones when you're not speaking. And I would like to take questions at this time, either on the recommendation for the Fund 14 or the select opportunities. We will take separate votes on those, but we will not have separate presentations on each of those recommendations. Questions from committee, from council? All right. With that, we are looking for a motion from Member Lavender.
Thank you, Madam Chair. Just for the council, we spent a lot of time on these 2 investments, and the longer we looked at it, the more impressed we were. So, first of all, based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Responsible Oversight of RVK, I move that the State Investment Council approve commitment of up to $100 million to TA 14-A LP subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender. That's a proper motion. Do we have a second?
Second, Nick Tejas.
Okay, we have a motion by Member Lavender, a second by Member Tejas. Do we have any discussion on the motion to approve the commitment to TA14? All right, with that, we will have Carrie call the roll on this motion. And Carrie, we were informed by Member Allen that she had to leave early, so she may not be on with us anymore, but we do still have a quorum, I believe.
Correct. Thank you. Commissioner Garcia-Richard.
Yes.
Harold Lavender.
Yes.
B. Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina. Nick Tejas.
Yes.
John Bingaman.
Yes.
And Miss Allen, let me just double check that you are no longer on the call. We thought she'd done. So Mike, let me go back to you.
Said yes.
I'm sorry, I can't hear you. So Madam Chair, that's a 7-0 unanimous decision.
Very good. Thank you so much, Carrie. So with that, we have approved the $100 million to TA14. Let's now go on to for the Select Opportunities Fund. If we have no further questions on that recommendation, I'll go to Member Lavender for a motion.
Thank you. Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve commitment of up to $40 million to TA Select Opportunities Fund 2A LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you. That's a proper motion. Do we have a second?
I'll second. I second.
Was that Member Rawson?
Yes.
Okay, we have a proper motion and a second by Member Lavender and Member Rawson. Any discussion on the motion to approve the Select Opportunities Fund for TA? All right, with that, I'll have Carrie call the roll.
Commissioner Garcia-Richard.
Yes.
Harold Lavender.
Yes.
B. Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Nick Tejas.
Yes.
John Bingaman.
Yes.
And this is Kathy Allen, and I'm finished that meeting. I'm back on the call. So yes for me.
Great, thank you, Kathy. So Madam Chair, that's a unanimous 2-0 approval.
Thank you so much, Carrie, and thank you to the representatives from TA for being on the line with us today. With that, we'll move to agenda item 4, and we're going to hear from our CFO, Mr. Shipp.
Madam Chair and members, I'll be as brief as I can. I'm on page 360. Just a couple of things to point out, as I try to do every month. Under item number 1, we are
Hello.
You will now be placed into conference. This conference is being recorded.
every month.
This conference is being recorded.
Under item 2, I've also included the investment holdings report for the month of February. If anybody has any questions on that report, I'm happy to answer those questions. I did want to point out on the budget to actual, especially for our new members, that the office is funded by the land grant fund and the severance tax fund. And after the annual audit is completed, any unused amounts are reverted back to those funds. And then under item number 3, and I think I mentioned this last month as well, Moss Adams is currently completing their agreed upon procedures for the first 2 quarters of the fiscal year. And the targeted completion date for those reports are the end of March. Once those reports are completed, I will forward them out to all of the members. And then to get a little bit into the detail, I'm going over to page 362. This is the summary for the budget to actual. The far right-hand column shows any unused budget at the end of February, as most of the existing members, maybe not the new members, but the budget is divided into 3 categories: the 200s, the 300s, and the 400s. The 200s is the payroll-related matters. The 300s are the contractual matters. That's where all of our contracts for consultants and external public managers are at. And then the 400s is everything else, including travel. And then if you could thumb over to page 367, I just wanted to make a couple of points on the investment holdings report. This is an index for the IHR. You can go on the first 8 or 9 pages and see a snapshot of the assets for the various funds as well as the clients. And then the rest of the report is basically comprised of roll forwards for the month, so you can kind of see what's happening in the funds. You can see what's happening with the pools. You can see what's happening with the clients. So I would just like to say, if anyone, once you get into this report, if you have any questions, please don't hesitate to email me. I'm very good at responding to emails, or I can get on the phone and go through any questions that anyone might have. And then if you could thumb over to page, I guess it's 403. I did want to point out, these are the notes to the investment holdings report. I did want to point out the monthly contribution under the first bullet from the land office was $78.1 million, which is an increase from January of about $4.3 million. And then I also have indicated for year-to-date comparison purposes that the February 2020 contributions from the state land office was $109 million. So relative to the prior year, we are down, I guess $30 million or so. And then under the second bullet, the monthly beneficiary distributions, this is the distribution that we make monthly for all the beneficiaries. They're reflected in the report. And I would, some people ask me, what's a good way of getting your arms around the investment holdings report? A good thing that I would suggest is some of these items noted in the notes page. If you go through and kind of isolate where those appear in the actual investment holdings report, I think that would be a very good learning exercise for especially the new members. And then on the third bullet, I did want to point out that the fees column in the investment holdings report reflects the drawdown of the funding from the land grant and the severance tax permanent funds. And you should see those amounts reflected in the fees column. And then under the fourth bullet, I did want to just point out for the SBIC, the carrying value within the report is about $97.4 million. And I do mention the small business recovery loan program, the value of about $40 million. We are in the process of having a conference call on, I think it's Friday, with the New Mexico Mortgage Finance Authority. And as everyone knows, there was a bill passed. There will be additional funding as well as some retooling of this program to the tune of, I think it's adjusted up to about $500 million. So we will see some activity in this area in the near term. And then on page 404, the only thing I want to point out on this, I like to include this. This shows the beneficiaries for the land grant permanent fund, and you can see their ownership percentage as well as the total in the far right-hand column by beneficiary. And of course, the total is going to total up and agree to the total of the land grant permanent fund at the end of February. If anybody has any questions on how this works, I know there was a bill passed that I think there's going to be a vote of the citizens of New Mexico about an additional distribution of 1.25% going forward. And Charlie might have something to add on that in the future, but this schedule will be changing a little bit based upon that additional distribution, but I'm happy to answer any questions on that. Other than that, that's all I have, Madam Chair, and I'm happy to entertain any questions or comments.
Thank you, Mr. Shipp, and I think Mr. Bingaman already knows what a great resource you are, and I'll just invite the new members to kind of pick your brain on in terms of the SIC budget because of your wealth of knowledge. I just did want to mention on the Land Grant Permanent Fund inflows from the State Land Office, the month over month, and then the year over year. Even in the midst of a pandemic, economic shutdown, we are still showing fairly strong returns at the Land Office. Not as strong, obviously, as last year, but we are anticipating hitting another $1 billion mark this fiscal year. And the numbers that you are reporting, they are showing production for 3 months prior. Just want to remind members that the numbers that show up on Brent's report actually are reflecting production from 3 months prior.
Madam Chair, thank you for pointing that out, and we really appreciate everything the Land Office does for us, and the inflows certainly are appreciated, and we will continue taking everything you send over.
Well, we'll continue working hard to pull that money in. Questions for Mr. Shipp? All right, great. Thank you so much. Next, we're going to go to agenda items.
You will now be placed into conference. This conference is being recorded.
Do you want to have discussion on this, or is it
Hello. Madam Chair, if that was a motion, this is Harold, I'll second your motion.
Is Evan with us? Do I need anything more formal than what I just said? I move, maybe something like I move that we appoint Member Tejas to the CIC.
This is Evan. That sounds perfect to me.
Okay, and that was seconded by Member Lavender. Any discussion on the motion? All right, can I have Carrie take a roll call vote on the appointment of Member Tejas to the CIC?
Commissioner Garcia Richard?
Yes.
Harold Lavender?
Yes.
Lee Rothman?
Yes.
Tim Jennings? Mike Messina?
Yes.
Kathy Allen? Yes. And John Bingaman?
Yes.
And Mr. Jennings, I didn't hear your response. No, maybe he's...
Tim, are you still on with us?
Yes.
Oh, thank you so much.
Sorry.
A unanimous decision.
All right, great. Congratulations to Member Tejas. So with that, we've rounded out the membership of our CIC, which is always good to have that membership full up there.
Madam
as
Chair.
I mentioned before, yeah, Member Tejas?
Yeah, just wanted to say thank you for your support, Madam Chair, and fellow council members. Really appreciate it. I just want to make sure that as I take part in the CIC that I really do what I can to be of service and help continue the impressive work that the team has been doing. Steve, Vince, and Brent and team has done remarkable things through the last years, getting the council, on a really good track record, and it really shows in the performance of the investments in the permanent funds. So thank you so much.
Thank you, Member Tejas. And as mentioned earlier, those meetings are open to council members to listen in on. Obviously, if you're not on the committee, you don't have a vote on the committee, but you will eventually get your vote on the council if the recommendation comes from the committee to the council. So those are very informative meetings and sort of an opportunity to dig in deeper into the details of these investment recommendations. All right, with that, I'm going to move to item 6, old or new business. And before I go on to our presentation we have today, do I have any other old or new business from members? So at my request, we are going to have a...
Madam Chair, excuse me, this is Steve. Were you going to have Charlie speak just briefly about legislation?
Yeah, I was going to do that after the IEFA presentation.
Thank you.
Okay. So we're going to go to Tom Sanzio. I hope he's on the line with the Institute of Economics and Financial Analysis. Tom has 17 years of experience with the City and State of New York in senior financial and policy management positions. He was first Deputy Comptroller for the State of New York, and he oversaw the finances of 1,300 units of local government, the annual budget of 44,000 government contracts, over $200 billion in state and local municipal bond programs, and $156 billion global pension fund. Tom is the Director of Financial Analysis for IEFA, the Institute of Energy, Economics, and Financial Analysis, and I have invited him today to give us a snapshot of what we can expect for oil and gas markets in particular. So, Tom, with that, I'm going to have you take it away.
Okay, thank you very much for inviting me, and I had actually the pleasure of listening for the last hour or so, and remembering the kinds of meetings that I was involved in for many years, and you run an efficient shop, so I'll try to continue in that. So what we're really looking at is if a fund is interested in moving from the current position that they're in through a low carbon transition to some alterations in the composition of their fossil fuel portfolios, then what I want to describe to you a little bit about is how that's evolved, that dynamic has evolved, and where we see an outlook. And then a few things have happened in the past week that I wanted to bring to your attention that are not in the PowerPoint that I submitted. The PowerPoint on the first 3 substantive slides, which are 411, 412, and 413, you don't really have to look at them. They basically make a point that the oil and gas sector has contributed massively to pension funds over many, many decades, and of course to your state. So I don't need to talk to you at all about that. And that's on the pension fund portfolio side, that has basically come to an end. And So what we try to do with the slides is to show Exxon's particular direction since they're the leader, basically leading the market, leading the industry, leading the world economy effectively for many years, and now basically near or at the bottom of the list. And the other slides show that the energy sector likewise has for most of the last decade been near the bottom of the Standard & Poor's 500. And from the 1980s until now, they were 28, 29% of the Standard & Poor's 500. Today, they're 2.5% of the Standard & Poor's 500. And then one of the other slides looks at the MSCI Fossil Free Index and shows that there are modest but superior results over the last 10-year period compared to a fairly standard index that many of you are familiar with. The industry, the markets in the last couple of months have gone up. The oil prices have gone up, and we see that as being temporary. I'll be more than glad to talk to you about it. But these longer-term financial trends are the ones that we're concerned about. And then I have a slide in there on page 416, which I think is something you might want to take a look at some point, of the Norwegian budget situation. Norway is not unlike New Mexico. 25% of its economy is based on their ownership of oil and gas. About the same amount of their annual revenues are based on oil and gas. And for the last 20 or 30 years, they've been very blessed, I guess is the best way to put it, to be able to, every year, the blue line on the chart shows that every year their revenues have far surpassed the needs in their budget. The red line is their deficit, and they've been able to accumulate what is essentially is a sovereign wealth fund of about $1 trillion. What the chart shows is that from here on in, the Norwegian government, which probably knows about as much about oil and gas as anybody in the world, has said that that will no longer be the case, that they can no longer rely on the oil and gas revenues, and that will be true on their chart through 2050, and that the deficit will become greater over time. That, to me, is a fairly powerful long-term outlook from a knowledgeable participant in the industry. And so the question becomes, what do funds who are involved in the, in the fossil fuel sector and have part of it in their portfolio, what do they do? There's been a lot of discussions of how to get to fossil-free portfolios. And this past week, I received, and it's up on my website for those of you who want to take a look at it. It's a 3-section report from BlackRock and a 3-section report from another firm that you may be familiar with, is Makita. And it's advice. It's fiduciary advice to the New York City pension funds as to how they should proceed with their attempt to get to a fossil-free portfolio. The importance of it is that the importance of the research is that it goes well beyond the city of New York's pension portfolio, although it is very specific to their needs. And it's a survey of, part of it is a survey of many of the funds around the world that have elected to reduce or eliminate their fossil-free holdings, and why they did it, how they did it. And then there's some summary analysis of the reduction in holdings and the returns. And the returns are all shown in all of the options that were applied to be either at or better than what they would have gotten had they remained with their standard portfolio. They then go in and discuss many of the issues that I'm sure you would have questions about: tracking errors, rates of return, volatility, and they go through it and explain in the level of detail that I heard a lot of your folks explaining this morning, how you can get to the fossil-free portfolio and how it is actually an important step that can be taken to defend against risks that are occurring within the oil and gas sector right now, least of which, of course, is the most of which maybe is the underperformance that I just referred to. But then the historical risks looking forward that have to do with carbon policy, but also the competition that the industry is experiencing. I think that kind of document, which is advice from a very large investment house to a pension fund under contract, is probably better than anything I could ever provide to you. And the research is thorough, it's comprehensive, and having been involved in this discussion for about the last 10 years, I think it actually adds new information that those who are responsible for carrying out the fiduciary duties of a fund would have in their process. And it's many of the things that I have emphasized over the years and implicitly in what I just said, which is the situation is such that a fund can be designed in a manner that is fossil free, maintains your returns, keeps your commitments to the various funds that you have on your public expenditures that you need to make and your budget targets that you need to make, and to do that in a way that is also protective of the long-term risks that are involved with the holding of fossil fuels right now. So I would, you told me to do this quickly, so I tried to do as quickly as I could. So with that, I would take questions and be willing to discuss any of the topics that might be on your mind on this.
Thank you, Tom. For committee members, Tom's presentation starts on our page 407. We appreciate the information. Any questions for Tom?
Madam Chairman, this is just a comment. This is Kathy Allen. On various corporate boards that I sit on, this issue of ESG, the environment, social responsibility is a hot topic. And in fact, my company's been doing a lot of work around ESG. And if those of you who read Larry Fink's, BlackRock's chairman's letter, annual letter to investors, you can see that it's not only is he encouraging firms to look at this from a financial performance perspective, but also a social responsibility perspective. So I think that the trend will be for most corporations to move away from investment in fossil fuels. And so I think this discussion is a great discussion for us to be having today.
Yeah. I think what the literature now is what this particular proposal that I'm telling you about is showing is it takes the ESG discussion a step further from the point where the engagement discussion, which is what many funds do when they are working with their partners who they're investing in, and many of the funds have come to the conclusion that in this particular sector, the engagement strategy has reached its limit, and that the next step should be to consider this. And I think what the BlackRock studies are saying to you is, even if you're not going to take a step, and they go through various options, so it's from the more modest approaches that leave you with some risk in the portfolio on fossil fuels to those that eliminate it altogether. But even if you're not going to take those steps, it seems to be like they're saying, and BlackRock used to be one of my advisors also, it's like they're saying you need to look at this, and you need to vet it, and you need to make a decision based on your fund. One of the interesting findings in there is all the funds they studied, almost none of them did the same thing. And although from a financial point of view, the mechanisms are easier to handle now, the philosophy and mission of funds, the thinking of people locally about how they might approach this is all very different, but it can be accommodated. And I think that's what the BlackRock and the Makita papers are basically saying to investment funds now. There are different philosophies, but there are different ways to approach this problem and to address it.
Commissioner, this is Steve, if I may. Tom, thank you for that presentation and for mentioning the Black Rock Makita study. Just for the interest of those on the call, Jim Makita is a graduate of the Albuquerque Academy. We're very proud of him. And he has a fine investment advisory firm. That's an aside. Tom, would you please send us a link to that study so that we can read it?
Sure. Should I send it to?
Why don't you send it to the commissioner, if you would, at the state land office, and they can forward that to the members of the council. Thank you.
Okay. Yep. Okay. I'll send it this afternoon. It's 6 studies. But they're not long, so you don't have to. It's not that painful. There's 3 studies from Makita, 3 studies from BlackRock, and they are kind of like parallel advice into the fund, like you might do. You might get 2 or 3 sets of advisors. These are 2 sets of advisors that are informing the fund as to how they might want to proceed. The second thing you might want to keep in mind is when I send this, these are were given out from a Freedom of Information request. And so there are redactions in it. As a former pension fund official, I think if you were interested in further discussion, they might collegially provide you with an unredacted version, but I'm not sure. I can't speak to them. But I know because we had asked for it publicly that they had certain things that they needed redacted. So what's on my website and what I'll send you is redacted, but not much. And the basic summary, just the numbers are really redacted and a few corporate names. So it's still a very useful document.
It sounds like Mr. Moise might have a connection there with Mr. Makita. I appreciate your comments from Member Allen, and your expertise and experience your perspective will certainly be welcome in this conversation as we move forward and start to consider, our direction.
Thank you. Thank you very much.
Thank you, Mr. Sanzio. Unless there are any other questions, we'll move to thank you for being here with us today. We're going to move to Charlie to give us a legislative update and tell us about the passage of HJR 1.
Madam Chair, thank you very much. I will be very brief here. As you know, we've been updating the council with the weekly notes report, and that we'll have a big summary for you on Friday. So HJR 1, paraphrase the governor, certainly that bill passing after about a dozen years of trying was a big deal. And that was one of the biggest pieces of legislation to come out this year. HJR 1 is the constitutional amendment that should go to the voters likely in November of 2022. If passed and approved by Congress, that could start drawing an additional 1.25% of the school permanent fund. That's the largest piece of the LGPO, okay? That's the common schools portion of the LGPO. That would go towards early childhood education and also towards K-12 programs and other things in a 60-40 split. Keep in mind other beneficiaries, the other 20 will not receive additional distributions should this pass, but their shares would grow as the school's drawdown accelerates at a faster rate. So everybody would maintain their ownership. It's just the schools would be getting theirs at a quicker rate. So in that sense, it's different than the 2003 amendment, which raised the spending policy for the LGPF beneficiaries. It's more targeted. And they could start drawing down that money at the end of FY23, assuming voters approve it, and Congress also has to sign off on that. So what does that mean? That means probably a growth in projected distributions of about $210 million per year in that first year, FY23. 60% of that would go to ECE, 40% to K through 12, which would help address the outstanding Yadi Martinez court ruling. So about 125 to 85 million split. In perspective, the LGPF distribution for FY23 could grow to 1.2 billion. That's compared to 900 million for the upcoming fiscal year. There were other bills, and but why don't I open that to questions at this point? and we can summarize the other ones in the weekly, but I know we're getting close to the lunch hour, so I kind of defer to the committee and the council.
Let's see if there are questions on your first item. Questions from council? All right. Do you want to go on to the other bills, or just?
Sure, I can do it very, very briefly, okay. Commissioner. SB3 was another one that touched us directly. This is the continuation of the low-cost small business loans that are administered by the New Mexico Finance Authority, NMFA, and we'll be chatting with them, as Brent referenced, on an updated MOU. They've drawn down about $40 million of that so far, and that's a big number for these loans out of the STPF. About a 1.6% interest rate on those, and there's a lot of flexibility in how those get repaid, but we would earn something. Two other bills that did not make it that would have affected us pretty significantly. Senate Bill 149, which was a 4-year fracking suspension, and that one did pass its first committee, but did not get beyond that. The other one was the thing we chatted about quite a bit on a state bank proposal, House Bill 236. That bill did pass its first committee. There were some concerns about, well, how it would all work and whether the issue has been studied enough, and it was tabled in House Appropriations. So those two will wait for another year. There were other smaller bills that do impact us, including one that puts us as one of 24 members. The state investment officer would be one of 24 members in a sustainable economic task force, and that group will work on strategy as New Mexico transitions toward renewable energy. That one's awaiting the governor's signature. There was another bill that helps the Energy, Minerals, Natural Resources Department with a fund that they are establishing for mining reclamation work. It would allow them for long-term, like 5-year horizon, money in that fund to be invested through our investment committees. So those are the bills. We'll have some other updates this week, and I'm open to questions, Madam Chair.
Thank you, Charlie. Any questions on those items? Okay, with that, our next council meeting is Tuesday, April 27th. Steve, I don't know that we've heard anything different about whether or not we'll be in person.
No, Commissioner, we have not.
Okay, if you get that information, certainly pass it on to council members. And with that, we'll go to public comment. Charlie, do we have any public comment?
Madam Chair, we have no submissions this month.
Okay, very good. Can I have a motion to adjourn?
This is Harold. Move we adjourn.
All right. We have a motion to adjourn. Any objection to an adjournment motion? With that, we're adjourned. Thank you, folks.
Bye, everybody.
Thank you. Bye, everyone.
Bye-bye.
Bye.